Now let's talk about the supply side. What most people refer to as tokenomics, but it's really the supply side of your token economy, which is the valuations, vesting schedules, allocations, the whole shebang. There are two very key important parts here, and I will run you through our tokenomics template to kind of explain how to create this section. But the two very important parts that you need to understand is there's a valuation segment and then there's a distribution segment within your, within the supply side of the tokenomics. The valuation is very critical because you can have a token price chart that looks like this, regardless of what you do, if you start with a very, very low valuation. Valuation is just a product of your price multiplied by your circulating supply, which gives you the market cap, or multiplied by the total supply, which gives you your fully diluted market cap or your fully diluted valuation. If you start at zero, which you technically can't really, but if you start very, very low, your token price can only go up. It doesn't matter what you do. It can't go below zero. Right? It can only go up. Now, it might go up in the short term and then come back down again, like a meme coin, but it can only go up because your valuation is so low. What most projects fail is they have a very, very optimistic valuation for their token. And of course, by extension, that means a very high price, whatever that is, right? And they launch at that price. And then the token charts just look like this, and then they go here. This is because all of these tokens that keep being sold are not met by an equivalent amount of buy pressure. You might be selling 100 tokens here, and the token price may be $10, right? You might be selling 100 tokens here, that's 1K. Let's move myself, that's 1K worth of sell pressure. Maybe at this time, you only have $500 worth of buy pressure. Right? Only $500 are going into buying the token. Your token price will fall. The token price will fall, right? Simple, it's pure supply and demand, right? Wherever the supply, wherever people selling and wherever people buying meet, that's the equilibrium, and that is what your token price is. Anyways, without going too far into this, if you start with a low enough valuation, your token price will look great. The problem is, like for example here, if you start with this valuation, like if your token price was, let's say, 10 cents or whatever it is on this chart, right? Your token price will go sideways. It's going sideways. That's pretty good. It's much better than going down by 90%, right? The problem is that you might not be able to, well, you won't raise enough money, or not enough, but you won't raise as much as you want because your valuation is smaller. You just have less dollar value that you can get from VCs, and I'll explain that in a second. And secondly, you won't go on the exchanges that you want to go on, right? It doesn't look as bullish of a project if your valuation is very low, which means that you won't go on the top tier exchanges, like you won't get Binance, Bybit, etc., unless your valuation is at least like $50 million probably. You also won't raise enough money in order to pay for those listings. You also probably won't go on like the bigger exchanges. You won't have enough money to spend on marketing and therefore to close out very big launchpad raises. And so on and so forth, right? So there's costs and benefits, but fundamentally, if you start very low, your token price will go up, right? You can't do anything else if you start at zero. Obviously, take what I'm saying with a pinch of salt. But if it starts at literally zero, it cannot go low, right? It cannot go below that. So very, very important. You need to balance out what you can have and what you want to have, right? Now, there is two parts to the valuation. There's the real and there's the fabricated. There is a video that I'll be doing which is talking about how to correctly value your tokens. And there are 5 things that we've identified at Simplicity Group that drive the value for the tokens. 5 categories of value. That is real value, right? Well, not all 5 of them. 3 of them are real value. The other 2 are kind of like the more social value, right? More fabricated value. But regardless, your real values, for example, if you are giving discounts on trading fees, the value that people, the amount of money that people will save over, some amount of time, that is the real value of the token. If people can buy the token, stake it, and they don't have to pay trading fees, right, or whatever. That's real value. For most projects, that real value is down here. It's very, very small because there are very, very low numbers of people. If you don't have a lot of users, then the value of the token isn't going to be very high because you're not saving that much fees, for example, right? The other part is the fabricated part. So as I said, your token price, it's a subsequent of demand and supply, but your value and your price are different things. This is kind of like your fundamental underlying flaw, right, if you will. Like it's the real value behind the token. Your price is just how many people are buying versus how many people are selling. That's all it is, right? It's just your market cap. It's a It's a function, or rather it's a product of your market. What this means is between the two is arbitrage. If the token value is $10, if I can save $10, right, by buying and staking one token, but the price of the token right now is only $2, obviously I'm going to buy the token and I'm going to stake it and I'm going to save myself $10, right? And because I'm doing so, whenever I buy the token, the price will go up a little bit. Maybe now it's, $2.50 or whatever. And other people will keep doing this until the price of the token reaches $10, right? Which is the value of the token. And the inverse is true, right? So this is very important. I'll describe all of this in the other video, but the point is valuation is very important, because if you recall in the economy video, we described that once you figure out all the flows, you can start quantifying how much buy pressure you will have based on where it's coming from and how many users you expect to have and how much you expect them to spend, etc. When you take all of that and you apply kind of all that buy pressure over the course of maybe 3-4 years, however long it takes to get all your tokens out into the market, that's a good kind of general metric to use, that will be your value. That will be your real value. The fabricated value is then maybe you spend a lot of money on marketing, so you have a lot of people just buying the token for speculative reasons, right? And then they're just pushing the token price up, right? Maybe you are using some of the money that you fundraise to deploy that money into the liquidity. Maybe you give it to the market maker to buy back some of the tokens. That's kind of the fabricated value, right? It's more so to do with your just the token price. Anyways, this distinction doesn't really matter. The important thing is you have real value, and the importanter thing is that you need to have a valuation that's reasonable, right? Number 2 is distribution. This is your allocations and your vesting schedule. So who are you giving the token to? Is it just to investors? Is it to the team, advisors, airdrops, community, rewards, extra bonus rewards, whatever it is, right? And the vesting schedules. This is how quickly do these tokens come out onto the market. What I'm going to do now is run you through how to build the tokenomics. So, as I said, in that economy video, we have described an economy where I think the net buy pressure was about $70,000. No, it was $50,000, I think, right, of buy pressure, which means that every single month there was $120,000 of tokens being purchased, and there was $70,000 worth of tokens being sold. So we have $50,000 worth of tokens being purchased and then not sold. Our goal, therefore, is to keep that in mind and to make sure that when we look at the amount of tokens being sold per month and we multiply it by the token price, the listing price, we don't go above that number, generally speaking. Now, let's do this. So, for example, the token ticker can be test, right? Or have a course, I guess. Whatever, doesn't matter. That's probably too long. Anyways, remember what I said, right? Your token valuation is important, and the way you calculate that is you look at the value, you look at your kind of speculative value, etc. You sum all of that up. Let's say that you have a very big community, you have a lot of real users, and they're already giving you money. You're going to use some of that money to buy back the token. You expect them to buy the token to use it in your economy. Let's say you want to have a fully diluted valuation of $40 million. So in this case, the token price will be 0.04 because you have a billion. The total supply, completely irrelevant, right? You can have 10 million tokens if you want, but then the token price will be $4, right? The important thing is your valuation, is the product. These are just inverse. The more tokens you have, the lower your price. The less tokens you have, the higher the price. It doesn't matter, right? It operates the same way. It's just in this case, maybe people are going to be selling 2 tokens per month. In this case, people will be selling 200 tokens per month. The dollar value is what's important, right? Not the actual price and not the actual token supply, but these two, they work together. Let's say it's $40 million, right? You think that that's fair. Okay. How much do you need to fundraise, right? There are two very critical parts here. You don't want to allocate too much to investors, right? You don't want to give investors a total of 40% of your supply. The maximum really is 25 to 30 if you're like a big project, or maybe even 35 if you're deep infrastructure, but generally speaking it's no more than 25% is the target, right? We know also that the liquidity part, you don't really want to deploy more than not you don't want to deploy more than, it depends on the project, but generally speaking it's between 5 to 8%. So let's say in this case it'll be 8%. Right. Now, to investors, let's say for your seed investors, you want to give them 10%. This is an exercise of you put the numbers in and then you play around with it to see what you want, to see to see what will be the best for you. So, for example, if we say 10%, let me just move this up a little bit. Let's say we give 10% to the seed investors, to the private, we'll also give 10%, or maybe to the private we can give 13%, and to the public we can give 2%. These 3 rows we can hide. And just as a reminder, this is our free template. You can get it, you can use it. There'll be a link down in the description below for you to get this template, play around with it. It's completely free. We decided to make it free because we wanted to make sure that projects have ability to make their own tokenomics quite well and not be stuck using other terrible templates. If we hide that, there you go. So the total allocation to investors is 25%. How much do you need to fundraise, right? Maybe you need to fundraise, you've done the maths, you need to fundraise $2.3 million, right? So let's say for your seed allocation, the token price, of course, needs to be lower, right? You need to give the seed investors a discount. Generally, you don't want to give them more than like 3 or 4 times a discount compared to the listing price. So you don't want to give them a discount of more than like, 66 to 75%. So let's say this can be 0.01 right on there. It's a 4x difference. For private round, they're coming in a bit later. You already have your initial LOIs. You already have a certain amount of users by the time you will start your private round. So they don't need to have a valuation that's that low, right? Because the risk for them is very greatly reduced. So maybe 0.025. And then a public round, will just be, let's say 0.0375 or something. There you go. So we've worked out the prices. How much are we raising? Well, as a matter of fact, as you can see here, we're actually raising quite a lot of money. We're raising $5 million, which means that maybe we can drop this down, make it a little bit more, make it more of an incentive for investors. Maybe, remember what I said about the valuation. You want to be lower to have a higher token price or to have better token performance. So maybe we can drop the fully diluted valuation to 0.035, right? Just like that. That means that this would need to be 0.0, let's say 33, for example, for these guys. This can be 0.009, for example, not quite 4x, but close enough. This can therefore be 0.00, maybe 0.175 or something like that, right? To get a nice 2x, there you go. Cool. Now we're raising, 3.8 mil. Look, spend the remainder of that raise on marketing. The more money you spend on marketing, the better, right? So I know you needed to raise less than this. I can't remember the number that I said earlier, but now we're raising more. That's not a problem. But you see how we played around with these numbers. We played around the valuations to get what we to be more reasonable. Maybe you actually don't need to raise this much. Maybe we can drop the valuation down even lower. But remember, you want to go on KuCoin, BitGet, Gate. You don't really want to have valuation lower than 35 million. You're not going to come across as very serious. If you wanted to launch on Binance, well, then this would need to be at least like 80 million. I don't know exactly what Binance's requirements are, but they're not going to list a project that's very small, right? They don't have a particular fully diluted valuation requirement, but if you're going on Binance, this would need to be much higher, right? Bybit, OKX, etc. But let's say you're not that big of a project. You're happy with 35 mil. That's more reasonable. You don't need to raise that much money. You're going on Mexi, maybe BitGet, maybe Gate. This is fine. This is good. Then you think, okay, well, we want to allocate, let's say 15% to the team, 2% to advisors. Standard. You don't want to give the team more than like 15, 20% ID. Like you don't want to give more than 20% to your insiders, right? The team, the advisors, any partners. If you include partners, maybe like not more than 25%. Let's say for the team and advisors, this is fine. The treasury, we can come back to that. The rewards. Let's say you're still the AI agent marketplace. You want to incentivize people to use you rather than AI16Z. So you want to make sure they have a lot allocated to rewards. Let's say 40%. That said, however, maybe we can hide these because we don't need them. Maybe you want to do a big airdrop. So actually, instead of rewards being 40, maybe the rewards we can make 20. Then we can have a very, very big 25% airdrop. And then, the remainder we can keep in the treasury. There you go. Your allocations are now done. These, of course, will be subsequent of, how much you want to fundraise. Again, the stages of the fundraise, your marketing strategy. Maybe 25% to the airdrop is absolutely ridiculous. Maybe that's way too big, right? Maybe that's not enough. Maybe you want to have very long-term rewards for the future. You don't want to just have rewards, for the first year. Maybe you want to have rewards for the next 4 years, which means that, of course, you have a longer vesting schedule, but you would also probably need more rewards so that the actual value of the rewards per month is, decently high. Maybe you have other tranches. Maybe, again, you have partners. Maybe you have like airdrops on a particular ecosystem. Maybe you need to give some tokens to Binance for their Binance Alpha program. Whatever it is, it's all product questions. These allocations are all subsequents from that. For investors as well, maybe your initial round will actually only be family and friends. So this will be an F&F round. You don't want to allocate too much to them because the valuation will be much lower. So let's say it'll be like something like that. Very, very low, right? But that's the inherent point of this round. Maybe you don't want to allocate them only 10%. You don't want to allocate 10%, sorry. Maybe you want to give them only 3%. As you can see, the raise value is now you're only raising $75,000. Maybe that's the case. Maybe this is your incubator fee, right? Or your accelerator fee. Or maybe this is literally just a family and friends round. These people invested when you had absolutely nothing. You didn't even have an MVP, right? That's why your valuation is so low for this round. Obviously, again, the product of price. So this is fine. Maybe then you want to add in another round. You want to have private, then you maybe want to have a strategic round, for example. The strategic round will be, maybe like 5%. This is your influencers, whatever it is, right? This all depends on strategy. This all depends on how you're going to market, what you need to do to raise, the roadmap of your fundraising and everything else. There's so many different factors. I can't explain them all on this, on this course, but just think logically. At the end of the day, just think logically, right? You don't want to break general kind of rules. You don't want to give more than like 25% to investors, for example. You don't want to have less than 5% allocated to liquidity. You don't want to give more than 20%, maybe even no more than 15% to insiders like the team. Beyond that, it's up to you. Whatever matches what you're doing the best, that's what you need to do. Again, there's so many different factors that you need to consider. Message me if you have any questions, but very important to get that right. But once you figured out the allocations, it's now time to move on to the vesting schedules. So for example, how much are we allocating at TGE to all of these tranches? For liquidity, generally speaking, you want to, it depends on your tokens, and depends on what exchanges you're going to. It depends on, is it DEXs, is it SEXs, which ones? It depends on maybe you have like additional liquidity pools. Like for example, in an agent marketplace product, maybe you want to allocate some liquidity to bootstrap those initial AI agent creators, whatever it is, right? It depends on what you're doing. But 5 to 8% is generally fine. And generally what you want to do is allocate maybe like a third of that straight away. So that third you'll give to market makers for centralized exchange liquidity, and you'll deploy onto your decentralized exchange liquidity pools. Maybe a third is too small. Maybe you can do 50%, maybe it can be 30%, maybe it can be 40%, whatever it is. It doesn't really matter, but you can, again, think logically, speak to your market makers, discuss, and then they'll tell you what to do. There won't be a cliff, and then there'll be like a 6 to 8 month vesting, generally speaking, because you don't want to come across as if you're just taking these tokens and dumping them into the market. You want to make sure that these are actually used for liquidity, and that's what the tokenomics are representing. So you want to have some sort of vesting schedule for them. Generally 6 months is fine, 6 to 8 months typically. Anything longer than that is just weird, in my opinion. For the airdrop now, let's say, you don't want to allocate, you don't want to have too high supply on launch, but maybe that's the strategy. Maybe your whole idea is to give away a quarter of your supply straight away to all of your dear users. That might work. You create a lot of very rich people very quickly. They're probably not going to sell the token, and they're probably going to be supporting you for a very, very long time. So maybe the strategy here is 100%. Of course, if that's the case, you would need to allocate more tokens towards liquidity, right? Because you don't want to have a big problem where there is just not enough liquidity on the market, right? And of course, that means you need to also allocate a lot of dollars to the liquidity as well, in case people are selling. So, you have value there for them to sell into. Which means if this is 100, maybe this actually needs to be 10%, and this needs to be 50%. Right? All these things, they play together. You change one number, you have to change the others, generally speaking, right? And I have a video on this, just on how to, fill out this template. So check that out. We also have articles, but there are so many different things that you have to consider. And look, again, if your valuation is low enough, you don't have to get this exactly perfectly, right? If your valuation is low enough, if it's 10 mil, if it's 12 mil, if it's 8 mil, whatever, a lot of mistakes can be forgiven. If you have higher valuations like this, speak to someone, speak to us, message us. Even if it's not us, just get some professional guidance, get professional help. it would really be important. Because again, for example, if you allocate 100% here with this allocation to liquidity, you know, and you don't really know what you're doing with your liquidity, your token will just straight to zero, right? Let's say we make this 20%, and then let's say we have a 3-month cliff and we have a 12-month vesting, right? Maybe the vesting can be quarterly as well. This doesn't change anything. This is just for your developers to know what to code into the, you know, kind of the vesting portal. But yeah, it's just for you to know that this is quarterly. So every quarter, you know, there's a certain amount of tokens are unlocked from this tranche. In fact, let's keep it as monthly, whatever. Rewards, you know, we wanted to have these for 4 years, so that's 48 months. 0% at TG, we don't need that at TG, we have the airdrop. Treasury, you know, that's just your internal company treasury. In fact, let's keep it 48 months, but then the lock can be 12 months. You know, we don't want to use that in the first 12 months. For the team and advisors, generally it's 12 and 9, and then 36 and like 30. Again, very malleable, but generally for the team, this is what's expected, right? It's quite a long vesting schedule, quite a long cliff, because the team is earning a wage. You're earning equity. In fact, I think 15% of token supply to the team is too high. What are you doing? You have equity. This is a utility token. You know, grow up, right? Anyways, that's that. And now we're talking about the VCs. The VCs are the interesting one. I have an article specifically on fundraising tranches, and I will kind of summarize the key points here. Your unlock at TGE is inversely proportional to your cliff and the vesting schedules, which are working in cohesion. So for example, the higher the unlock at TGE, the longer the vesting and the cliff and the vesting should be, right? You don't want to allocate a lot of tokens at TGE and then, you know, allow them to dump the remaining supply very quickly. On the flip side, if the unlock at TGE is very small, maybe you can have, you know, shorter cliff and then shorter vesting schedules, right? That's the relationship between these two things. And of course, you need to factor in the valuation of the token. If the price of the token is very small, then that means that, you know, very quickly these investors will become profitable, which means you are disincentivizing them from holding onto the token for long. So you have to force them to hold onto the token for long by having cliffs, right? You know, 4 times delta is fine, right? If you are doing a family and friends round, this may be even lower. You know, as I said, maybe this is 0.04, for example. $4 million valuation, a much higher delta to listing. The reason why this has to be like 3 to 4 is because it's better for the launch pads, right? It's easier for your community to trust your investors. But in reality, it's not something that you have to, you know, adhere to fully. But let's say this is the price, this is the delta to listing. You don't want to give them too much unlock at TGE, and you want to have a longer cliff because, and, you know, longer vesting schedule. Because if we look here, if you scroll to the right, we can see by this calculator, which is conditional formatting, we can see when the investors become profitable. So the seed investors, by month 15, will become profitable because we have a 12-month cliff. What happens if we have no cliff? You can see they're profitable by month 3. That means that if, for example, these investors have, you know, 5%, let's say 7.5%, generally between 0 and 15% is the norm. You know, the higher the valuation, the lower this typically is. If this was like $80 million, you wouldn't really want to allocate more than this. If this was $10 million, you can, you know, unlock 10%, 15%, whatever. This is kind of standard. Well, actually, no, sorry. For the public round, this will be like maybe 20%, maybe 25%. The public round is a bit different, right? These are launch pads, these are retail investors, etc. And the valuation, of course, is very high relative to listing. So, you know, the more the merrier. In fact, maybe we can make this 25%. The vesting and the cliff for public round is normally like, you know, 4 months, 6 months, whatever. Maybe there's a cliff, like a 1 month cliff or something like that. So this is pretty standard numbers, right? Again, depends on the launchpad, depends on your strategy, depends on who you have participating in the public round, right? There's a lot of depends going on. Just think logically. For the private round, let's say we're going again with pretty standard, let's say 8 months and then, you know, 24 months vesting, right? Now, again, if we scroll to the right, we can see our seed investors are profitable by the 3rd month. What this means is that your seed investors realistically will start selling tokens. They'll start selling tokens. And they will be selling tokens and selling tokens and selling tokens and selling tokens and selling tokens. The private investor only becomes profitable by month 20. By the time the private investor has unlocked enough tokens for them to make a profit, The seed investors have been selling tokens for, how many months is that? For 17 months, right? That's probably not good. That's probably not very balanced. So that's why with a valuation that's so low, a $4 million valuation compared to your listing at 35, that's why these guys need a much longer cliff, maybe even longer than 12 months, but generally 12 months is kind of like the longest, and a longer vesting schedule, let's say 36 months. Because the longer the vesting schedule, that means the less tokens you have per month. Private, on the other hand, with a much higher valuation, they can do maybe a 6-month cliff and 24-month vesting, maybe even a high unlock at TGE, right? Again, this can make sense if these guys are investing super early on, right? Maybe you have a pitch deck, maybe you have a very rough MVP, whereas the private round is investing, you open a private round after you just signed MasterCard as a client, and all of a sudden you have a lot of, millions of transactions or whatever it is, right? So it depends. Again, the strategy to this, you just have to think logically, read a few articles from Y Combinator on structuring your rounds, etc. Now, if you look at this, we can see that the seed investors are still becoming profitable early on, but it's pretty balanced. The seed investors by the 16th month, the private investors by the 18th month. Maybe the seed investors can get only 1.5% unlock at TGE. Maybe the private investors 8%. Right? And then we can see here the difference is even closer. 16th month, 17th month. Fine. This calculator, by the way, we can simulate what happens if there's multiple X's from launch. If you have a 2X from launch, then the private investors, of course, will become profitable faster because they have a much smaller cliff, which means that they get the tokens much quicker. If we have a 3X from launch, then the private investors become profitable even faster because as soon as their cliff ends on month 6 or rather month 7, it doesn't take them long to become profitable, whereas the seed investors, of course, have to wait for much longer. So if we're being quite optimistic, maybe we look at the 2X, maybe we look at the 3X price, and we can see that actually private investors are getting it quite well. So maybe this is the balance. Maybe we give these guys a little bit more TGE than the private investors, but they have a longer cliff, and therefore, this is pretty close. That's not a problem. If it's 1X, that's pretty close. That's not a problem. If it's a 3X, if it's a 3X, the seed investors are getting shafted a little bit, but the valuation is still low enough. So you can use this template. You can see when investors are becoming profitable. You can make sure that it's all balanced and fair for the investors. Up to you, again, which investor rounds you want to incentivize. Maybe you're doing a private round and it's not going very well. It's taking you a while to close the round. Well, you can increase this to maybe 15%. Right? Maybe you can reduce the cliff down to 4 months. Maybe you have very serious investors and therefore, this actually needs to be 12 months, right? It all depends. It all depends on so many different factors. And they're all outlined in the article. So read the article. I'll also link that below in the description. So now we've created the supply side tokenomics. The allocations are, a result of our strategies and our marketing and our go-to-market ideas. The valuation is the result of us calculating the value of the token and assuming our community buy pressures and other key parts. The vesting schedules are balanced and fine, and they make sense. They align with our roadmaps, our strategies, our go-to-market, etc. We looked at this section. We can see the investors are fine. We now also looked at this section over here. We're looking at the tokenomic sell pressure. We can see that in the first quarter, we don't have that much sell pressure, and then the sell pressure goes up quite a bit, generally because of the I don't know because of what, to be honest, but the sell pressure goes up quite a bit. Maybe some cliffs ended, whatever it is. And then it goes back down to around 900k, then it goes back up to 1.2 million, and then after the 15th month, it goes down to 600 grand. Which means that in the first year, we have quite a bit of sell pressure, and then after that, it goes back down. There's actually a chart here on this template, this one right here. You can see the tokenomic sell pressure. You can see it's above 1 million for the majority of the first year, and then it goes down to 600k. And it goes down lower and lower since then. So now all we need to do is make sure that we've done the maths. We have our financials. We can see the buy pressure going in based on different users, based on speculators, based on buybacks, whatever you have. We calculated that. We have aligned the tokenomic sell pressure with that. For example, maybe in the first year, this jump from 500k sell pressure to 1.1 million. Maybe this jump happens too quickly. Maybe in our roadmap we can see that 6 months after launching the token, maybe 7 months after launching the token, we will be expanding into a new market, and therefore we can expect there to be a lot more buy pressure from that market. Well, that means that we need to have some higher cliffs, right? Which means that we can't have this amount of sell pressure in the first kind of 6 months. So we can go back up here. We can extend the cliffs. Maybe the airdrop needs to extend a little bit. Maybe this needs to be 6 months. Maybe the private round needs to be 7 months, right? So then we come back down here. We can see now we've really slowed down the sell pressure until, you know, month 8, month 9, where it starts to come up to $1 million. This much better aligns with our roadmap and our projections. This is fine. Okay, so now we can look back, you know, go back up here, make sure that everything is still fine because we changed the VC thing. Is this fine? Okay, now the seed investors are much better off. So maybe the seed investors, they can get, you know, we drop down the TGE allocation 2.5%. Again, it's a little bit more fair, so that's fine. Maybe that doesn't matter. Maybe the seed investors deserve to have more money. They supported you when you were at your earliest, so that's fine. You know, you can look at all these other charts, and I have a video explaining all of these charts, but it's just your emissions, you know, tokens unlocked, vesting schedules, valuations, distributions, etc. So there's a lot more here. You have liquidity modeling over here. If you input the numbers for concentrated liquidity pools, so Uniswap V3, Radium, etc., you can model it out. So for example, we're launching with 0.0, what was the launching? 0.035, so maybe the upper bound will be 0.05, and then the lower bound will be 0.01. There you go, we model that out. We can see what happens to the token price, if people are buying, selling, etc. We have a little simulator here that allows you to understand how many tokens you should allocate into your DEX liquidity. There's a video explaining this template, but this is how you create your supply side of the tokenomics. You have to make sure it's aligned with your projections on your revenues and your buy pressures. You have to make sure that it's aligned with your strategy, with your token launch strategy and your product go-to-market strategy. You have to make sure that the exchanges are happy, the investors are happy, the launch pads, the retail community are happy. You have to make sure that you're not oversupplying the market, your valuation is fair. You need to make sure that all these things are right. It's very easy to get wrong. Again, if your valuation at launch is $10 million, not really that much of a problem if you allocated 25% or 40% to your airdrop, or whether you gave it 20% or 100% at TGE, or whether the investors have 12-month cliff or a 6-month cliff, right? If your valuation is $35 million, these things start to matter. If your valuation is $80 million, these things really matter. Because at $80 million, a little change from 12 months to 11 months can mean an extra $300,000 of worth of tokens being sold, right? All these things, the higher the valuation, the more dollar value is applicable to every single number here. And you have to be more, like, increasingly more precise, because your margin for error goes away. So this is how you design the supply side of your token economy, or the tokenomics, again, as most people refer to it as. Check out the template below, message me for more help, and stay tuned for more.